topics and opinions expressed on the following show are solely those of the hosts and their guests and not those of W4WN Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4WN Radio, its employees, or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4WN Radio.
This is Beyond Confidence with your host, Divya Parekh. Do you want to live a more fulfilling life? Do you want to live your legacy and achieve your personal, professional, and financial goals? Well, coming up on Divya Parekh's Beyond Confidence, you will hear real stories of leaders, entrepreneurs, and achievers who have stepped into discomfort, shattered their status quo, and are living the life they want. You will learn how relationships are the key to achieving your aspirations and financial goals. Moving your career or business forward does not have to happen at the expense of your personal or family life, or vice versa. Learn more at www.divyaparekh.com, and you can connect with Divya at contact@divyaparekh.com. This is Beyond Confidence, and now here's your host, Divya Parekh.
Good morning, listeners. So thrilled to be here with you. And today I've got a fascinating story about kindness. Veronica, one of our audiences, sent out that she had been helping out homeless people and she was burned out. And then she was sitting down with one of her friends and they told her that you're extending kindness to all these people. How about yourself? And then she said that she decided to take a break and from all her kindness activities and be kind to herself. And it's such an important concept. And actually, I learned from her. So usually, I don't know about you, but I see myself as the last person that I pay attention to. It's always about clients. It's always about other people. So this weekend, I gave myself a dose of self-kindness. And I gotta tell you, it's nice because when you're kind to yourself, you have more energy and you can give more kindness and energy to others. So something for you to ponder over. And for those of you who have got our books, either one of them or any of our 14, 15 books that we have written, The Entrepreneur's Garden or Expert to Influencer, it's going to give you the life you deserve and position yourself for the meaningful impact that you deserve to deliver. Because as human beings, it's our responsibility not only to live happy lives for ourselves, but to deliver impact as well. So, excuse me, it's important that we help others as we help ourselves. So get our books if you have not, and I want to thank you, each and every one of you who have got our books. So let's welcome our guest. Welcome, Michael.
Thanks for having me.
Absolutely. So we always begin with the childhood, and that's all of us began our lives. So do you recall a moment or a person that even stands out for you today who had left a positive mark on you in your childhood?
Oh, certainly. There's two people, really, two of my grandparents, my grandpa and grandma. They were huge influences in my life early on. I think they taught me my first lessons about money management. For instance, my grandmother, when I was really little, we played this game every time we go to lunch. It seemed she'd tell me to have this saying, I want to increase my vocabulary so that I may speak more intelligently. I was saying this when I was like 5 or 6 years old, 7 years old. And then over the years, she would teach me new terms, to increase my vocabulary. And a lot of them were financial related. So looking back, I learned how to talk about the very basic nature of stocks and bonds when I was 7 or 8 years old. And I think those planted the seeds that made me a money manager later on in life, because I was never intimidated about finance or any of those issues. And then my grandfather too, he taught me a lot of financial lessons later in my life. For instance, when it was time to get my first car, he didn't want me to take out a loan and pay interest. So he gave me the loan interest free. So I paid him back. He helped me with college, and he was just a very disciplined man who lived a life that I wanted to embody in my own ways as I grew older, because I felt like he did it right. He had a lot of friends, and was always just, he just seemed to have a very good sense of who he was and who he wanted to be. And he lived that in his financial life and his personal life. So I still think about them a lot. I wrote about them in my book, and I think they're an inspiration to even this day when they're not here anymore.
That is fantastic. And so many nuclear families, as they're happening, what happens is that we lose touch with our families, and so many times people move away. But it's important to remember that how important that family is, because your story is so powerful. Your grandparents decided the course of your career and your life. And as you said, that by the time you were just 8 years old, you're so comfortable with it. So tell me, as you grew up, did you have any other interest, or was finances your interest from the beginning?
Yeah. So when I was around 7 or 8, I also became interested in something called baseball cards. This was back in the 1980s I grew up in, and back then baseball cards were very popular. And I discovered, yeah, they were awesome. And I think I looked at them like stocks early on, because there's this thing called the Beckett Price Guide that would come in the mail every month. That was my favorite day of the month, when my Beckett Price Guide would arrive, because it would tell you like all the prices of the cards, and there were little arrows up and down if they went up or down in value from the previous month. So I was just fascinated by that. And I think combining my grandparents' inspiration with that hobby, that really like planted the seeds even further for me to become an investor later in my life. Fast forward to college, when I was in between my junior and senior year, I was actually a government major at Georgetown University. I thought maybe I'd want to be a lawyer or work on Capitol Hill or something like that. But then I got this internship opportunity at a venture capital firm in Boston. And that summer changed my life, because I kind of rediscovered what I really liked about investing in baseball cards. I just realized you could do it in terms of companies. And so I became really fascinated at that point with investing, and decided to pursue that for my career.
And so we are going to get into the financials, and we will be tackling for entrepreneurs, for professionals, and anyone, because usually most people are doing some form of a job or something. So as you continued, where did your career take you?
Sure. So I graduated just as the tech bubble was blowing up in 2001. So it was really hard to find the kind of job I wanted. The venture capital firm that I'd worked at previously wasn't hiring. Most of the major banks and good jobs on Wall Street were hard to find, because there were a lot of hiring freezes. So I had to kind of bob and weave. First, I worked at a bank for a little while, and then I got, as the market got a little better, an opportunity to go to Fisher Investments. They're the biggest registered investment advisory firm in the US. And I got to work for Ken Fisher, who's a billionaire founder, a brilliant market mind, also a wonderful person. And that's where like I really kind of learned my craft in a professional sense. I was an equity analyst there. And I had a good run. Later on, I left because I always kind of wanted to be an entrepreneur.
I think see. So like, let's kind of touch upon when you mentioned that you were equity analyst.
Mm-hmm.
So can you share with our audience, what is an equity analyst?
Sure. So you're basically a research analyst, and you're assigned to certain companies, usually within a specific coverage area. So I had 3 different sectors that I covered. So my job was to become an expert on what makes those sectors go up and down in terms of the business cycle, and then the investment cycles that follow that. And so I covered, about around 50 stocks or so at a given point in time. And my job was to make buy and sell recommendations. I didn't get the final say, the portfolio managers did, but I was a support person for those decision makers. And I also got to travel around the country, which was really neat, because I got to do investment roundtable meetings when I was an analyst. So I had some client interaction, and that was really key for me, actually, looking back, because at the time I was doing that, 2008 came along. Of course, the great financial crisis. Most people remember if they were an adult through that period.
Yes.
And so, going to do those meetings around the country in that turbulent market climate, it kind of just reinforced a lesson I started to learn at the front edge of my career, which, when the tech bubble burst is when I was just getting into finance. And then a few years in, I had the great financial crisis to deal with, and interacting with the clients and seeing how stressful that was for them. because almost everything struggled that year, unless you were 100% in cash. I had a lot of empathy for the clients, and it kind of reinforced in my own mind that if there's one thing I want to be good at as an equity manager, it's doing well in bear markets. That just seems like crunch time in a market. It's like almost like in basketball. A lot of times the game's decided in the fourth quarter. That's when the clutch players show up, and Kobe Bryant or Michael Jordan would take over the game. Well, I think in a lot of the investors I admire, that they tend to do best in the bear markets, and that's part of the reason they have such good long-term track records. Anybody can be a genius in a bull market. If you take a bunch of risk and get a little lucky, you can do wonderfully well, better than some professionals, better than Warren Buffett in a bull market. Probably a lot of people could do. But in the bear markets is where Warren Buffett's of the world excel. That's where he's generated the most of alpha or outperformance through his career. And because I had seen, the tech bubble and then the great financial crisis, and I really grew up in a lost decade for stocks. I mean, I entered the industry at the end of an epic 2-decade bull market, and then the stocks didn't go anywhere from 2000 to 2010 or so.
Yeah.
And so, it kind of, it created my philosophy, which is risk management's the number one priority.
That's very powerful. So, like everyone else, I incurred losses in both those times. Now, going back to, there may be a lot of people in our audience who may not know the bull markets and bear markets. Can you expand on that?
Sure. I think the most important thing to realize about the stock market is it goes up most of the time. And the longer you invest, the better the chance that you'll come out in a positive return. But bear markets are usually defined as a drop in the market averages, so something like the S&P 500 or the NASDAQ of 20% or more. If that happens in a day or two and it snaps right back, most people wouldn't say it's a bear market. A bear market's usually a decline of 20% or more that's kind of longer lasting and more difficult to work through. So, some people debate, was 2022 a bear market or not? Well, the market went down over 20%. I kind of think it was, but it was a short-term one. So bear markets can vary in length. They can last years or even a decade plus, like 2000 to 2013 or so. And then a bull market is just when the market's going up, which it does most of the time.
So you mentioned that you had worked with Cam Fisher himself, if I got the name correct. Tell us, what did you learn from him, and what were some of the lessons that you carried back?
Sure. The number one lesson I learned is that markets are ruled by supply and demand. And that was a really important one, even more important than I realize now that I'm at this point in my career and I look back. And the reason I say that is because a lot of people subscribe to different religions in terms of how they invest. For instance, some people believe in something called value investing, which is buying the cheaper stocks in the market, cheaper relative to their earnings power or cash flow. Is what I mean by that. Not necessarily the price per share, but relative to the fundamentals. So out of favor companies that are bargains. And that strategy has done really well over the last 100 years. But it has not done well over the last 10 plus years. Something called growth investing has done better over the last decade. That's the companies are growing their earnings and revenues at a really high rate. Usually those trade at higher valuations because they're more attractive fundamentally. And we've been in a cycle where growth stocks have just trounced value stocks. But those aren't the only two types of investors. There's also people that look at charts and they make their decisions based on patterns in the charts. I'm somebody who believes any method that I just mentioned can work really well if you're disciplined in how you practice it. But because these strategies work well at different times, I don't believe in just looking at the market one way. I like looking at it as a holistic market that is buyers and sellers, and anything that moves supply and demand for shares is going to be the main thing to focus on. So that way you don't get stuck in a long period of time where your style is out of favor. Because when that happens and you're not doing as well as your neighbors, you're often tempted to abandon the strategy at the exact wrong time. Because just when value stocks are going to finally do well, a lot of people will probably throw in the towel. So Ken taught me to be agnostic on style, think in terms of the market cycle and the big picture. If there's going to be a bull market, you want to be mostly in stocks, get your asset allocation right. That's the most important investing decision, is what's the proportion of stocks, bonds, and cash in your portfolio. That will influence things more than any other decision you make. And then within the stock market, he taught me how to think macro oriented. So which sectors are going to do best based on the overriding picture that we see in the economy and the market, and then what types of stocks are best representative of those themes that you may identify. So he taught me to look at the market in a way that I think is kind of unique. And it's one of the reasons he's been successful for a very long time. He started his firm when I was born, and now they manage $200 billion plus. And the reason he's been able to survive and thrive over time is he's always adapted to the different changes in the market. I think that's really important for any investor to do.
So basically what I'm hearing is that see where the winds are blowing. And when you talked about supply and demand, is also looking at consumer trends, market trends, where what is happening, what are the new, and also kind of knowing whether it's a fad trend or it's a paradigm shift. Because if it is long term, then you know that this investment it may not do so well in the near term, but it will be good in the long term. Is my understanding correct?
I would agree with everything you just said. Yeah, you have to have some patience because nothing outperforms every day, every week, every month, every year. So you really have to decide what's your time horizon. How long do I have to invest, and how do I maximize the odds of me doing well relative to my objectives over that time period? And that's different for different people. So it's important to have a benchmark for your portfolio. A benchmark is anything that could be considered a broad market index that has a return history that's consistent with the goals that you're trying to pursue. Some people want to beat the S&P 500. That's their number one goal. That's fine. That's called relative return focus. So what you got to do there is you got to figure out what parts of that benchmark, the S&P 500, are more attractive or less attractive based on where you think the market cycle is. And what you do is you overweight the areas you like better, but you also own some stuff in the areas you don't necessarily like. And that's just in case you're wrong. It's called a core and counter strategy. And other people may not care about beating the market. They may care about funding their key goals in their life. That's a completely different set of objectives. I think more people fit into this category that I've worked with in my 20-year career. And that's why I think it's really important to decide what are your personal goals, how are they intrinsically linked to the core values that you have, and how can you be inspired to pursue those goals and make sure you can fund them on time. And when you figure that out, it's just about how much is each goal going to cost me over what timeline, and what's the return and savings rate I need to have to average to fund those goals on time. And you can use something called a Monte Carlo simulation. If you work with a financial advisor, almost every financial advisor probably has that capability. Or even if you wanted to buy your own Monte Carlo software and do it yourself, it's not that expensive. What that process does is it takes a lot of historical returns, projects the probability of you getting to each of your goals on time. You don't want to be somebody who's got 100% certainty of reaching your goals, or you're probably not dreaming big enough. So what I encourage people to do is try to be above 80% if you can, in terms of the likelihood of getting there. That way, if some bad luck comes along, you happen to invest a big chunk of money right before a big market downturn, for instance, you have time to make your way back. The key thing with investing is to never put all your money in just one basket and then it blows up and then you're game over. If you stay in the game long enough, time is your most significant tailwind as an investor. So you really just got to know what you want to achieve. And then have a plan that you can use to get there that is fairly flexible, and gives you a lot of opportunities to win.
Yeah, and that philosophy definitely ties back to what you had initially mentioned about risk management. That was one of the things that you learned. And it does make sense because, as you mentioned, if you put all your eggs in one basket and if it breaks, then you're left for So now tell us, how did you transition from the corporate world into entrepreneurship?
By accident. I didn't plan on it. I was unexpectedly fired from my job one day on a Friday. I thought I was going in to have a meeting with my partner about our succession plan that we had been working on for like 2 years. We had an investment banker we hired. We had lawyers. I thought we were getting ready to paper our deal that we had talked about for a long time. And then I got a pink slip instead. And it was super surprising because I'd been at the company for 7 years. On paper, we were succeeding. We had grown the firm 500% since I arrived. I was running a portfolio of equities that was a strategy that you could compare to peer groups. And it was top 1% over a 4-year period. So I thought I was doing my job well, and we were doing well as a team growing the company. But I was let go anyways. And the main reason was just me and my partner didn't have a similar story about where we were trying to take the firm. We kind of danced around it because we couldn't have open conversations about it. But then all of a sudden, I think what happened is he made a decision. He wasn't ready to retire. And since we had this plan we were worked on, he saw me as somebody that needed to be removed from the situation. And that was super hard pill to swallow because I thought we were succeeding. I thought it was unfair, but really didn't matter. What mattered was I had to figure out what to do next. And it took about 6 days to think about it and talk to my wife and decided I'm going to start my own company. If I've helped grow this little firm this much, and I've worked at one of the biggest, best firms also, I have the capability to build my own firm from the ground up. So I'm going to just do that. And that was fine for a few weeks. I was starting to bring in new clients and everything was kind of starting to take shape. And then that former partner sued me because a few of these clients that we had worked with that wanted to follow me voluntarily followed me. And that was a real conundrum because now I'm not just like, without a paycheck all of a sudden. I've also got 6-figure legal bills I'm staring at in the future. And that made me reassess everything and almost wave the white flag because the financial analyst in me looked at the numbers and how stressful this was probably going to be and said, this doesn't make a lot of financial sense. But then there was another part of me that said, no. I don't think waving the white flag is going to feel good long term because what that will mean in my mind is I'm letting someone bully me out of my dream. And I was not going to settle for that story. Come hell or high water, I was going to have my own business at that point. So the long story short is I decided to fight back. I countersued him. And after a few years of back and forth, we actually went to a trial and I won the trial. And I also got my attorney's fees back. And now I still have a business and it's, thankfully worth a lot more than my IRA that I had to liquidate to pay for that legal fight. And most people in my industry would say, don't ever liquidate an IRA. There's major tax ramifications. That's the cardinal sin of financial planning. But I had to do that, Privia, because there was no other way for me to stay in the game. And I became so passionate about my business at that point that nothing was going to stop me. And so I'm really glad I made that decision in hindsight, but it really took getting fired to teach me why core values are so important and the story behind our financial plan is so valuable. Because sometimes we need to make our financial decisions not based on the numbers of the spreadsheets. We need to do it based on our own heartfelt story. Who are we? Who do we want to be in our life? And we need to attach those core values that we know that are important to us to our future goals so that they become like an emotional magnet to pull us forward, even when times are tough. Because no matter what plan anybody does, investment strategy, financial plan, whatever you want to call it, you're going to have to adapt at some point because something like what happened to me happens to everybody. I realized at some point in the road, somebody gets fired, somebody gets sick, somebody has, some other tough thing to deal with that they could never have forecasted. And the key when those things happen is you have to have something that keeps you on track and able to adapt and rebound. And that's why I think the story behind your financial plan is something that's really important.
Absolutely. And life happens, as you say. So on one hand, I'm really sorry what you went through. And on another, I definitely see the silver lining that your passion pulled you through. So kudos to you for that. I'm sure.
Thank you. That's why I call my firm Silverlight, silver linings. You just said the key word. I just decided at that time, I'm going to make a positive out of this negative. That's the only way I can look back later in my life and feel good about this episode. Because every part of our life is a scene in a movie, if you really think about it. And some of those scenes are wonderful and some of them are not so wonderful. But that's okay because every great story has ups and downs like that. The key is to know what your story is and to not let the external world or other people shape that for you.
Absolutely. So going forward, I'm assuming that now you're all settled and doing well.
Yeah. No, I mean, things are going good. My book just came out this year. I wrote a book called The 4-Minute Retirement Plan. The first third of it is about the story behind your financial plan. It's because I learned through my own trials and tribulations that wealth management without meaning is meaningless. And so we need to attach meaning to our financial goals, and we need to have a financial plan that makes sense too. But if your financial plan makes a lot of financial sense, but it doesn't emotionally resonate with you, you're not going to get where you want to be. So the book is about combining those two things. It ranked the #1 Amazon bestseller in its category, which I was excited about. And
well, congratulations.
Yeah, thank you very much. It took a long time to write, and I'm happy that I did it.
So now let's take a look at 3 different categories. Now tell us, like, let's say if people are, whether they're seasoned investors or they're just kind of starting out in the professional life, they have access to the 401k. So let's explore that, and then we'll go to entrepreneurs and then general investing. So share with us anybody who is just kind of starting out in their professional careers, or even if they're in there, what would be a few great strategies for them?
The first thing I would recommend for a young person is to get on a sound budget, because you can't save money if you spend it all. So there's something really simple called the 50-30-20 formula that says 50% of your income should go approximately to the needs in your life, the roof over your head, the food that you put on your table, etc. 30% would be what I call the fun money budget. This would be things for discretionary spending, that if you stay within 30% of your income allocated to these items, it should be what I call guilt-free consumption. Vacations, new clothes, new car, whatever you want to call it. But if you keep about 30% of your budget towards those things, that leaves about 20% left over. You can invest long-term in your future goals, whether they be retirement or something else. And that's a very simple, good schematic to budget based on. And then if you're young, I would invest mainly with your savings and equities, because that's the best asset class over the very long term. And if you're young, you probably have a long time horizon. So you don't want to have a lot of bonds or cash. You want to have, equities. If you want to have a little Bitcoin or gold or whatever else, that's okay. But I think equities are the best asset class for most people over the long term. So I think those are 2 things to keep in mind.
And what about people who are somewhere in the middle or getting ready to retire?
Well, I think in that case, you probably want to figure out what are some emotionally powerful goals over a few different time horizons. One thing I believe is that too many people have too many goals when it comes to financial plans. If you've got 5 or 6 different goals that you're trying to model, say you start working with, a lot of people start working with financial planners or investment advisors around midlife if they have the means. And that's a good time to really take an accounting of where you're at in your life, where you're trying to go. And I would recommend having 3 key goals. One short-term goal, which would be 1 to 3 years, a medium-term goal, let's call that 3 to 5 years maybe, then a long-term goal, which would be like 10 years plus. And I would try to figure out not just what the goal is and by when you want to achieve it, but why. And that's where your story can come in handy. The story behind your financial plan is the why of your financial plan. So what I teach people to do in the book that I don't think's ever been done before is I teach them how to write the story behind their financial plan. And that starts with thinking back, like we did in the beginning of this conversation, to key periods early in your life, key people, key places that really are valuable to you. My grandparents instilled in me a lot of my core values. And what I try to do with my own financial plan is link my core values to my future goals so that they're more inspiring for me to follow through on. And then I try to just make sure that me and my wife have the budget and investment plan that makes sense to fund those goals on time. And I do the same thing with my clients. One of my clients, for instance, is getting ready to retire pretty soon. And he's probably going to move from California to Georgia. And the reason that he's probably going to do that is partly financial. It's a little cheaper cost of living. Right now, he has a good job in California, so he can't leave here. But when he retires in a few years, he's a free agent. He can go anywhere he wants and write the next chapter of his life however he wants. And so Georgia makes sense for him because it's a little cheaper, but also because there's a particular community that has an unbelievable golf. They have like 3 or 4 golf courses. He's a big golfer. So that's kind of one of his happiness triggers, that he can meet there better than here. But even more important, this is a man who grew up in a house with 7 brothers and sisters. And family's one of his core values. And he's got 3 daughters that live around Georgia. And so for him, that's what makes retirement exciting. He envisions himself being in Georgia, being by his family, creating beautiful memories. and owning his time enough to where he can play golf as much as he wants, and he's got plenty of places he can do that. And so that's what I think you should try to do as you start to save money, is try to think, how do I allocate this money to live a better lifestyle and then ultimately have a better legacy?
Absolutely. Some really great nuggets over there. And now let's say there are a lot of entrepreneurs, and in entrepreneurs' lives, sometimes there is famine, sometimes there is feast, and and yet it's important that they start investing in themselves as well, because what happens is, as an entrepreneur, there's so much investment you have to put in the business. Like so many times, like you've got, even if you have got good cash flow back, you are like, okay, let me invest in the business. So how can entrepreneurs balance that growth and that long-term investment?
Sure. Well, it can be challenging. I know what that looks like, obviously. So I think the most important thing is to sometimes take a step back and look at the big picture. And again, this is where your story can be helpful. If you're passionate about owning your own business and you truly believe you've got a viable business plan, then you need to prioritize that. And it's okay to reinvest in your business. You're reinvesting in yourself, and that's an asset. It's also important for people that are self-employed to have other assets to counterbalance the volatility of their business if possible. Things like an emergency savings account can be very useful. That's one of the most important, like, protective defense mechanisms in your overall portfolio from what an unintended debt spiral. The thing that causes the most financial distress is when people get in credit card debt and things like that, where they think it's a short-term fix because they've got a cash flow crunch. So they put money on a credit card, and now interest rates are over 20%. And very quickly that can snowball and work against you in a way that's hard to climb out of. So that's why you want to have an emergency savings account of 6 to 12 months usually of your earnings, where it's just in a cash account or cash equivalent, very low risk. Money market, CDs, whatever you want to pick from there is fine. But I think it's important to have that fallback cushion, so that when the volatility of your business is not where you want it to be, you've got something to fall back on. It keeps you in the game for the long term.
Absolutely.
And entrepreneur, if they have a volatile income stream, it's important to favor a bigger emergency savings account. A W-2 employee could probably get by with 6 months of reserves. I would recommend that an entrepreneur have 12 months plus, just because that's what I had, and that's what helped me survive. I mean, I had a lot of savings, including my IRA, and now I liquidated my IRA, which was an extreme thing I didn't want to do. So sometimes you have to make a really tough choice: is your business worth it or not? Because it can get hairy. But my business today is worth well in excess of what my IRA was. So I'm glad I made that decision. And the key thing for everybody is to make your decisions that are true to you, not let fear or anyone else guide you down the wrong road. So sometimes if you're in a turbulent period, just try to take a step back, look at your life, ask yourself what you'll be happy or sad about in 20 years when you look back on this time period based on the decisions you could make. And try to talk to your future self and be your future best friend and make the decisions that are right for you.
Absolutely. That makes so much sense, that it's important to do things that are right for you. Now, question for you is that you've mentioned about some of the mistakes people make. Are there any other mistakes, financial mistakes, that people make that they should be on the lookout for?
Yeah, one common one right now is I think a lot of people have too much money in passive investments. I wrote a chapter called The Passive Investing Bubble in my book about this. So if you look at most 401k plans, for instance, they're very, very geared towards things called target date funds. Around 85 cents of every dollar it gets invested in a retirement account nowadays goes into one of these. And it's basically something that just invests purely in the broad market index, something like the S&P 500. And that's been a fine strategy over the long term because it's more cost efficient than hiring active managers that run mutual funds or ETFs. But one of the problems is now like 60% of the market is in passive investments. If you look at US stocks, around 60% is in passive, which means the majority of the market right now is just blindly buying the biggest companies, independent of their valuations, independent of their fundamentals. They're just buying because they're the biggest companies. because that's all that a passive index favors in terms of the factors that it looks for. The bigger you are, the bigger the weight. So something like Apple, for instance, great company, probably my favorite company of all time. I don't own it right now. The reason I don't own it is because it trades over 10 times sales, and that's a very high multiple to pay for a low growth company. It's been low growth over the last few years. But if you look at where Apple traded 10 years ago, it traded about 2 times sales. And at that point in time, it had around a $400 billion market cap. Nowadays, it's worth over $3 trillion, mostly because the valuation's gone up. And I think that's mostly because too many people have put money into passive investments that favor those big companies. And the thing a lot of people don't realize is the higher the valuation gets on a stock, the lower the future expected return is. So what I encourage people to do is have some passive investments if you want, but make sure you're diversified with some active strategies too. Active meaning something that doesn't just buy stocks based on their market cap alone. You could pick the stocks yourself if you think you're good at it and have that be a part of your portfolio. You could hire a professional like me to do it for you. You could invest in active mutual funds or ETFs. Any of those options is fine. Just counterbalance the active and passive weights in your portfolio and never invest too much in any one sector. Another problem with the S&P 500 is that like so much of it is in these big stocks, so much of it is in tech. If we have another tech bubble, that's going to be another lost decade of returns for a lot of people, and I don't want to see that happen.
Very powerful. And you've also mentioned that women are more disciplined investors than men. Can you share with us what's the reasoning behind that?
Sure. I wrote a Forbes article about this a few years ago, and it turns out that women they have a better emotional temperament than us men. Men take bigger risks, trusting their gut instincts more than they should, and women are more disciplined about the risk-return equation. So a lot of studies have shown that women do better over time than men in terms of their portfolios, and it's something that's analogous to what Warren Buffett says about investing. One of the things I always remember that he says is that it's important to have a decent IQ, but the highest IQ doesn't win in the stock market. The person that has a pretty good IQ, but a really strong emotional temperament and control of their emotions is going to do far better than somebody with a very high IQ and poor emotional temperament. So that's one of your advantages, Privya, over us men.
And you have talked about a lot of financial lies that we tell ourselves. So is there anything that you think we need to add on to for our audience?
Yeah, I think one of the most devastating lies we can tell ourselves is that no matter what we do, we can't get ahead. There's a lot of what I call future fatalistic thinking nowadays, where certain people don't even want to bother trying to plan for retirement because they just figure they'll never be able to retire, and it's too complex of a challenge for them to figure out how they're going to get from point A to point B. A lot of people also show that kind of thinking in the fact that over half of Americans don't have a will. That's the most basic legacy builder that you can do, is like as a favor to your family. Like when you're not around, like don't leave a mess for your loved ones to clean up. Just do a will. It's so easy. You can go on LegalZoom or any of these discount websites and easily get a template for not a lot of money to do one. So I think it's important to just have a positive story no matter what your circumstances, because what matters is everybody wants a compelling future. No matter what's happened to you in the past, you may have been burned in the stock market, you may have been subject to some other financial distress, but you can't let your mind keep going there and bring it into the present and future. You have to remember that every day is a new opportunity to begin again more intelligently. And at the end of the day, just never lie to yourself about what your true potential is.
Yeah, no, very powerful. And so everything that you have shared, it kind of brings us back to our core values and our mindset.
Yeah.
And the story that we are telling ourselves, what is serving us, what is not serving us, and getting rid of it. So which is so powerful that it's fascinating that regardless whichever field you're in, the success begins with the mindset and our core values. So I know you've mentioned about your book. So tell us about your book.
It's called The 4-Minute Retirement Plan. And the reason I decided to call it that is it's inspired by the story of Roger Bannister, who ran the first 4-minute mile in the 1950s. He was supposed to be retired from running at the time. He was a 25-year-old student at Oxford Medical School. But it had been about 10 years where the record for the mile run was like 4 minutes and 1 second. And so as no runner could beat that time year after year, a lot of people develop strange theories. Maybe it's not possible. Maybe people will die if they try to run that fast. A lot of crazy stuff. Since he was a physician, he knew there was no limit in the body to running a 4-minute mile. He knew it was a problem in the mind. So he decided to pursue that goal to prove to everybody that it was possible. And he did that after he ran in the Olympics and got 4th place. So he had a disappointing finish at the Olympics, but he didn't just retire on a down note. He had a new invigorating goal to go after, and he achieved it. And one of the reasons he achieved it is he had a super simple strategy to go with his positive story. His strategy was, there's 4 laps in a mile. If I run 59 seconds per lap, I'll achieve my goal. So his training regimen was based on that very simple insight. He ran 59-second splits at lunch every day. He only had a half hour to train, not as much time as his competitors, but he was really practiced at those 59-second splits. And on race day, he had 2 pace runners on his team that were in the race with him. And their entire job in the race was to run 59 seconds each lap. So one guy took the front end, the other guy took the back end, and that helped Bannister stay on pace. And when he described running that race, he described that he felt like he was running too slow at the time, and he had felt an urge to speed up. But he kept the pace. That gave him the stamina at the end to have his Bannister burst, and he ran his miracle mile. And I take that story and I apply it to retirement because it's the biggest financial riddle out there. It's the one that causes the most stress for the most people. And what I want to help people do is chunk down the race into manageable parts. I think there's 4 laps: a savings lap, investing lap, lifestyle lap, and legacy lap. So the book gives you strategies you can use that are proven over time to conquer each one of the challenges that are part of each of those laps. But I also remind people at the front end that, Bannister couldn't have done anything. The 59-second splits wouldn't have mattered if he didn't have a positive story to begin with, that he could achieve this. Optimism is essential for every major achievement, including in your financial life. So if you're telling yourself a negative story, you got to start right there, and you got to start editing that. And if you do that and you follow tried and true strategies, they don't have to be any one strategy or another. I give people a menu they can pick from because I don't believe it's important to just have perfect strategies. I think it's important to make progress on all 4 fronts. So that's what the book's about.
Very powerful. And where can people find you and your book?
Sure. Amazon and other major booksellers, Barnes & Noble, Target, you can take your pick. And my personal website's michaelcannivet.com, Cannivet. And you can also go to my corporate website at silverlight.us.
Oh, fantastic. So as we bring the show to a close, is there any last minute thoughts that you want to share?
I'll tell one really quick story. There's a man I talk about in the book named Theodore Johnson, who is a UPS worker. This speaks to the power of a story and a simple strategy. This is a guy who didn't think you could get ahead financially because he couldn't save enough. He made about $14,000 a year as a VP at UPS in the 1950s. And his friend asked him a question that changed his life. He said, "What if you just pretend to tax yourself? Why don't you pay yourself before Uncle Sam? That way you'll start saving money." And that one simple question completely changed his thinking. Instead of "I can't get ahead," he thought, you know what? He's right. That's a simple strategy I believe in. So he started putting 20% of his income every month, paying himself first. He invested all of it in UPS stock, which broke a rule because it wasn't diversified, but he got a little lucky. UPS did very well. And this is a man who never made more than $14,000 in a year. When he died, his fortune was worth $70 million. He left educational grants to a bunch of people to fund their college. He's a very normal person who had mega success because he told himself a positive story instead of a negative one. He had a simple strategy that he pursued relentlessly. If Theodore Johnson can do that, all of us can achieve worthwhile financial goals. We just have to start with the story, get that right, and then everything else will take off from there.
That's a very powerful story. Thank you, Michael, for joining us and giving us so many powerful insights. I'm sure this is going to help our audience, and I'm sure you're going to make your way to the book and take advantage of it. So thank you for joining us, and thank you, dear listeners. Absolutely. And thank you, dear audience, for being part of our family. and let us know what else can we bring for you, because our goal is to support you and serve you so that you can live the best life you deserve and want. And thank you, Juan, for making this show possible technically, and be well and take care. Until next time.
Thank you for being part of Beyond Confidence with your host, Divya Parekh. We hope you have learned more about how to start living the life you want. Each week on Beyond Confidence, you hear stories of real people who have experienced growth by overcoming their fears and building meaningful relationships. During Beyond Confidence, Divya Parekh shares what happened to her when she stepped out of her comfort zone to work directly with people across the globe. She not only coaches people how to form heart connections, but also transform relationships to mutually beneficial partnerships as they strive to live the life they want. If you are ready to live the life you want and leverage your strengths, learn more at www.divyaparekh.com. And you can connect with Divya at contact@divyaparekh.com. We look forward to you joining us next week.